The dollar index surging to new 20-year highs today on the back of June's red-hot CPI read. Those moves causing the euro to briefly dip back below parity with the greenback. But the chartmaster thinks the dollar may have climbed too far too fast. Carter Worth is here at the NASDAQ to make the case. Carter.
Well, that's right. On a tactical short-term basis, this is way overdone. I think everyone's on one side, and we saw the price action today in the market. After what was an initial reaction to CPI, of course, the dollar reversed. We know that rates reversed, gold reversed, and in many ways the S&P reversed. Let's look at some comparative charts. These are all the same chart but different time frames. So the first one is 2 years, and it's simply comparing the dollar to the euro. Two colors, two lines, and basically this spread is one of the wider spreads on record in terms of a short-term setup. So on a 2-year basis, I think the arrows are drawn like that. Let's look at the 5-year comparative. And we've got a very similar thing. So same circumstance, playing for a bounce in the euro and a give back in the dollar. Now let's go a little further. This is 10 years. Spread not quite as extreme, but still, my thinking is we get some convergence. But it's always about who you are in the market, what your time frames are. Let's look at this one. How about 20? So now what? They're dead even. They're dead even. Is it good? Is it bad? Is it overdone? Long-term structure of the dollar can go much higher. Tactically, it's way overdone. Let's do one more, two more. 30 years, and let's do all data. Going back to 75. Is it stretched? It's certainly not as stretched as that. That's the Plaza Accord, right, when they intervened. But the point is, on a tactical basis, I think you want to do what no one wants to do, which is start to trim your gains in the dollar and nibble on the euro.
Does this necessarily mean, Carter, that commodities will go higher?
You know, it's funny. I don't think those things have a relationship on a short-term basis. I mean, we know that obviously this dollar strength has hurt oil, but it wasn't hurting oil until it did, et cetera and so forth. So here and now, this is really about the dollar being stretched in and of itself.
All right, Carter, good to see you. Thank you. Carter Braxton Worth of Worth Charting. Guy, I know you're always with Carter, but what do you think of that, that chart?
I so dig Carter. I love what he's saying, because what he's saying is over a 20, 30-year period, the dollar is not stretched at all. I happen to agree with that. But in this period where you can trade it, it is stretched, and I happen to agree. I think the dollar can get sold off here. I think rates can go lower from here, and I think you might see a short-term bounce in the broader market. That bounce needs to be sold, and that dollar weakness needs to be bought, but it's probably not going to be over the next couple weeks where it comes to full fruition, which is, by the way, a great word that I use from time to time.
I think there's an argument to be had that what we're seeing in the 10-year is sovereign entities buying the dollar because of fears of EU weakness. So I get it. I'm hesitant to step in front of a dollar that is a runaway train, and I might maybe look at GLD as a way that's just like where you're not establishing yourself in a short position against a dollar, which is up and to the right. Now, Carter's charts are above reproach. I just think it's tough to step in front of a supply-demand situation like that, given where we are in an macroeconomic environment. I think it's tough to time that.